All right, in this video we're going to talk about intra-entity transactions. In particular, we're talking about obviously our parents and our subs. So a parent keeps their own separate books, a subsidiary of the parent keeps their own separate books. And the question that we're trying to answer is this idea of intra-entity transactions, transactions that go from one to the other. Now, in this video, we're going to give you kind of an overview of some of the topics that we're going to talk about. We're going to give you a base foundation, and then in subsequent videos, we're going to talk more about inventory in particular. There's a lot to inventory, and then we're going to talk about other assets. So for instance, land or machinery that a parent might sell to a sub or a sub might sell to a parent. So why are we talking about this? Well, we're talking about this because at the end of the day, we need to eliminate the accounting effects created by intra-entity transactions. And from a consolidation standpoint, the transaction never occurs. So, what do we mean by it never occurs? Well, think about this. If I'm Boeing, Boeing can't sell itself a Boeing airplane. So they make airplanes and they make a 737 airplane. And so at the end of the production line, they finish this airplane. They can't sell it to themselves. Okay? And so because they can't sell it to themselves, it's as if the transaction never happened. Now, prospectively, if we said that they could sell it to themselves, what they could do is if they're having a bad year, they would just sell jets to themselves to boost up sales. We don't want them to do that because they're not allowed to do that. And so at the end of the day, when we have a parent and a subsidiary, we can't have them just selling to each other in order to inflate their sales numbers. So in the consolidation process, if we do have a parent and we do have a sub and they're having transactions together, it's as if they never occurred because obviously they can do some manipulation, increase their revenues, thereby increasing their net profits, and then showing a better number than what we think as an investor. Now, why has this become such a big deal? Well, this is becoming such a big deal because of vertical integration. And so if you remember from your basic business classes, vertical integration is when a company who, let's say, makes shirts decides, hey, look, we're not just going to make shirts. We're not just going to buy cotton from a farmer. We're going to also farm the cotton ourselves. So we're going to grow cotton, and then we're going to pick it, and then we're going to make shirts. That's vertical integration. What do they normally do? They normally just make shirts. They take raw materials, turn them into shirts. Well, what they're now doing is they want to vertically integrate. They want to bring in the manufacturing or the raw material process. So they go out, they buy a farm, they grow cotton, they bring that cotton into their warehouse or manufacturing warehouse to then manufacture into t-shirts. We're seeing a lot of that today because of what we call supply chain issues. We're seeing issues on the supply chain, and so companies want to rein in on that supply chain, and the best way or the easiest way to do that is for them to go and buy their suppliers, okay? And so that's what we're seeing a lot today is that vertical integration. At the end of the day, it also reduces costs because of the profit markup that doesn't need to happen because they own the supplier. Now, because of this vertical integration, we're seeing a lot more inter-entity asset transactions, and that's why this has become a hot topic, and that's why we're kind of learning it in advanced accounting. Now, I want to give you kind of a simple example here to kind of help you understand what we're talking about. Let's assume that we have this parent, and this parent buys inventory for $7,000. Now, they normally sell that $7,000 worth of inventory for $10,000. So at the end of the day, they would book a $3,000 gain. 10,000 minus 7,000 gives them 3,000. Now, let's assume that they sell that $10,000 worth of inventory to a subsidiary, okay? And so when they sell that $10,000 of inventory, which they bought at 7, to that subsidiary, the subsidiary is going to book it on their books at $10,000. They're going to debit inventory, credit cash for $10,000. Now, what happened here? Well, what happened here was the parent gets to book a $3,000 gain. The subsidiary books a $10,000 step up basis in inventory. Now, if we were to eliminate this transaction, what really should happen is this parent right here should not have had a gain and therefore sold the $7,000 inventory to the sub for $7,000, and therefore the subsidiary books the inventory at $7,000. Now, what does the sub do? The sub then sells that $10,000 worth of inventory on their books for $13,000, thereby also producing a $3,000 gain. Now, when we talk about intra-entity transactions and we're talking about eliminating it in the consolidation process, what we're saying is we really need to eliminate this transaction here until this $13,000 or this inventory is sold to a third party. So, a gain must be deferred until inventory is sold to a third party. Once it's sold to the third party, then we can book our $3,000 gain here and book our $3,000 gain there. In another video, we're going to show you how we book it, but I want you to get an idea of what we're talking about. We're talking about we've got $3,000 gain here, we've got $3,000 gain here. At the end of the year, the subsidiary doesn't sell that $10,000 worth of inventory. Therefore, because they didn't sell it to a third party, they can't book the gain. They need to defer it. Okay? And so how do we defer it? We literally defer that $3,000 gain from this year until next year. Now with inventory, we don't expect inventory to be held for more than a year, so we would expect that next year they would get rid of their $10,000 worth of inventory, and so the following year we make an adjustment to claim that deferral that we made. Okay, so that's what we're talking about. A couple other terms that we will be talking about as we talk about intra-entity transactions when it comes to asset transactions, downstream and upstream. So to kind of give you the basis before we talk about it in other videos, downstream means when a parent sells to a subsidiary. Upstream means a subsidiary sells to a parent. Now, this can happen, so we're not saying that everything is usually downstream. Let's go back to our cotton farmer and our shirt producer. That is an upstream. We've got a subsidiary which grows the cotton, and we've got our parent, which is the shirt maker. Now, we also see a lot of downstream as well, and we can say that that downstream may be a parent, the t-shirt manufacturer, buying a distributor who actually distributes to local retail stores, and what happens here is the parent buys the distributor, hopefully to save a little bit of the profit, and so at the end of the day that parent sells to the distributor sells it to the end user. Now over here we're also going to talk about gross profit margin, so I kind of wanted to review gross profit margin at the very beginning. Gross profit margin is a ratio that we use in accounting to say how much profit do we get on every dollar of revenue. This is going to be important because this was easy, okay? They didn't sell the $10,000 of inventory, we're going to defer the $3,000 gain. But what happens when they sell half of their inventory? If they sell half of their inventory to a third party, the question that we have to ask ourselves is, how do we defer their $3,000 gain? Do we only defer half of it? Do we defer some of it? And so the way that we do it, the easy way to do it, is by using gross profit margin, which I'll explain in another video. But to get us started off, gross profit margin is gross profit divided by sales. That will give you a ratio. You can turn that ratio into a percentage. So for instance, we have a $10,000 sale price here. Now 10,000 minus 7 gets us 3,000. 3,000 would be our gross profit. So 3,000 divided by 10 gets us 30%. So our gross profit margin is 30%. So we wanted to review that so that you had that for the next video. So again, this video is all about giving you kind of an overview of what we're going to be talking about. In the next couple of videos, we're going to talk about the actual transactions and the actual consolidation entries that we're going to make. So again, we've got a parent and a sub. They're doing transactions together. Because they are so related together, we have to eliminate the transactions as if they haven't occurred.